Welcome to Spiedel's California Minute. I'm your host, Catherine Zidane. This week, we're covering reporting IRS partnership audit changes to the FTB. We'll be covering this topic in more detail at Spiedel's Federal and California Tax Update, along with whether making the pass-through entity tax election makes sense for your client, planning for TCJA provisions expiring at the end of 2025, an update on AB5 and worker classification after a recent court case, and more. To see a list of topics covered and get registered for a live seminar or webinar session, go to caltax.com. California law allows the FTB to assess California tax resulting from a federal determination assessed against a partnership as a result of a centralized partnership or CPAR audit. Like federal law, California will assess the tax resulting from a federal CPAR audit or administrative adjustment request against the partnership unless the partnership elects out or makes a push-out election. California requires the taxpayer to notify the FTB whenever there's a final federal determination, which is the date the IRS adjustment or resolution is assessed under IRC Section 6203. This is also known as the 23C date. This means that California taxpayers are required to report a change resulting from a CPAR audit when it's assessed, even if the taxpayer files a protest. It also means that the taxpayer is required to report separate serial assessments from an IRS partnership audit to the FTB. In reality, this may not be a big distinction because it's likely that the IRS will only issue a single assessment at the end of the audit anyway. Partnerships are required to report each federal partnership item change or correction to the FTB within 6 months of the date of each final federal determination if the partnership files an administrative adjustment request, is issued an adjustment, or makes a push-out election as part of an IRS partnership-level audit. Partnerships may make an election to push out the tax liability to the reviewed year partners rather than pay the liability directly. To report the change, the partnership should file an amended FTB Form 565 or FTB Form 568 if it's an LLC for the reviewed year and an amended paper Schedule K-1 for each affected partner if applicable. If the partnership originally filed a group non-resident partner FTB Form 540NR, the partnership should file an amended Form 540NR. The partnership should attach a statement that identifies the line number of each amended item, the correct amount or treatment of the item, and an explanation of the reason or reasons for each change. If the change is not reported within 6 months, an extended statute of limitations will apply. As mentioned previously, California law, like federal law, will assess the tax resulting from a CPAR audit or administrative adjustment request against the partnership unless the partnership elects out of CPAR or makes a push-out election. Unlike federal law, however, California requires any adjustments stemming from a CPAR audit to be reported on an amended return for the year being adjusted rather than on the return for the year the adjustment is made. To stay up to date with California tax law changes, subscribe to Spiedel's California Tax Letter. This monthly newsletter is written by California Tax Pros for California Tax Pros in plain English with helpful examples and charts. For subscription information, go to caltax.com and click Publications. That's all for this week. Join us next time for another episode of Spiedel's California Minute.